The term alternative investing is often used as a catch-all phrase for any assets outside of traditional stocks and bonds. While alternative investments can add significant value to traditional portfolios, the alternatives must meet specific criteria. My name is Bryan Minogue, founder of Cardinal Financial, and in this video, I will walk through the potential value of adding alternatives to your portfolio and what to look for. When I consider alternatives, I look for asset classes that will complement and diversify core stock and bond holdings. Ideally, I'm looking for an investment that is uncorrelated to stocks and bonds, and more specifically, an investment that tends to perform well when stocks and bonds struggle. To understand when stocks and bonds may struggle, it's helpful to consider the economic backdrops, which are the major drivers of the returns of stocks and bonds. Major economic environments can generally be categorized based on economic growth and inflation, and can be visualized in four quadrants. Stocks tend to do well when economic growth is surprising to the upside. At any given point in time, stocks are being priced based on the expectations of future earnings. So when economic growth surprises to the upside, higher earnings are expected to follow, and stock prices rise with that revised expectation. Bonds tend to do well when inflation expectations are falling, and bonds perform particularly well, especially relative to stocks, when both inflation and economic growth expectations are falling. Bonds typically pay a fixed coupon to investors, and expectations of future inflation are a major factor in the current value of a bond. If inflation decelerates and expectations for future inflation shift lower, the value of a given coupon payment, and therefore the outstanding bonds paying those coupons, increases. Also, if inflation expectations are coming down and economic growth is slowing or even crashing, that fixed coupon payment from bonds becomes even more valuable to investors. As you can see, with these two major asset classes, an investor has coverage in three of the four major economic environments. However, there is one environment where stocks and bonds both tend to perform poorly, and that's in stagflationary environments. Stagflation is marked by slowing economic growth and above expected inflation. Fortunately, these environments have been rare, with the most sustained period of stagflation occurring during the 1970s. However, 2022 was a recent reminder of how inflationary shocks can negatively impact both stocks and bonds. In 2022, global stocks declined 18%, and investment-grade bonds also declined about 13%. An alternative investment would ideally perform well in this fourth quadrant to round out the diversification of a stock and bond portfolio. Two asset classes to consider to cover this weakness are gold and managed futures. Gold has historically served as a store of value, a hedge against inflation, and a safe haven during tumultuous markets or geopolitical events. From 1972 through June 2025, gold has returned 8.3% per year, has demonstrated a near zero correlation to both stocks and bonds, and it also performed remarkably well during the stagflation environment of the 1970s. From 1972 through 1979, gold returned an annualized 36% per year, while U.S. stocks gained 6% per year and bonds gained 4% a year, before accounting for inflation, which was over 10% per year. That means stock and bond investors lost purchasing power during this time frame after accounting for the destructive impacts of inflation. Although gold was an excellent investment during the stagflationary 70s, its performance is not dependent upon inflation shocks. This may surprise some investors, but from 2000 through June 2025, gold has returned 9.6% per year, outperforming both U.S. stocks at 7.8% per year and bonds at 4% per year. Ultimately, gold is expected to produce a positive return over time, has demonstrated low correlation to stocks and bonds, and has performed well in stagflationary environments. All in all, a great recipe for an alternative. Managed futures is another asset class that has produced positive returns over time, demonstrated low correlation to stocks and bonds, and performed well in stagflationary environments. Managed future strategies are also referred to as trend following, as they seek to follow trends across a wide range of assets, including commodities, currencies, rates, and equities. This asset class has historically been challenging to access for individual investors. While these strategies have been employed by hedge funds for decades, they've only recently become available through relatively low-cost ETFs. Despite the short track record for live ETFs, trend-following managed future strategies have robust data supporting long-term positive returns and a lack of correlation to stocks and bonds. This chart shows the performance of a trend-following strategy across 67 markets, including 29 commodities, 11 stock indices, 15 bond markets, and 12 currency pairs from 1880 through 2016. This exhibit highlights how a managed future strategy has exhibited positive long-term returns, plus 7.3% per year, has consistently exhibited low correlation to stocks and bonds, and performed well in the stagflationary 1970s, adding 15.1% per year above cash. As importantly, trend following has demonstrated consistent positive performance in the worst periods for stocks and bonds. The following chart depicts the performance of trend following compared to a 60% stock and 40% bond portfolio during the worst drawdowns for a 60-40 portfolio since the 1890s. Positive and uncorrelated returns, especially in periods of stock and bond market weakness, is precisely what I'm looking for in an alternative asset. Next, let's see how the addition of gold and managed futures could impact the returns and risk of a complete portfolio. This chart summarizes the returns of U.S. stocks, bonds, gold, and managed futures from 1988 through June 2025. The bottom line of the chart, which is simply an equal-weighted mix of these four assets for demonstration purposes, highlights the benefit of adding uncorrelated assets to an investment portfolio. The diversification benefits are largely due to the positive long-term returns demonstrated by these assets and their lack of correlation, seen in this correlation matrix. Perfectly correlated assets would have a correlation of positive 1. Perfectly negatively correlated assets would have a correlation of negative 1, and uncorrelated assets would have a correlation of 0. Gold and managed futures have experienced a low to negative correlation with stocks and bonds, as well as a very low 0.06 correlation to one another. By combining these diverse assets, the sum of these parts is not a simple average of the individual asset class metrics. Instead, the equal weight mix is on the higher side of returns with far better risk and drawdown metrics. The equal weight mix returned 8.3%, which is greater than if you took the simple average of each individual component, which is 7.5%. At the same time, the volatility and maximum drawdown of the equal weight mix is lower than any of the individual components. The worst drawdown for the portfolio was only 11%, versus over 50% for U.S. stocks, 23% for 10-year Treasury bonds, 47% for gold, and 28% for managed futures. The combination of above simple average returns and significantly reduced risk yields a superior Sharpe ratio when compared to each component. For these reasons, I see value in gold and managed futures as potential diversifiers to traditional stock bond allocations. This is admittedly a pretty short list for alternatives, although I'm always open to other uncorrelated return streams. The problem with many of the strategies labeled alternatives is they are highly correlated to our traditional stock and bond allocations and are not true diversifiers. For example, real estate or REITs have historically had a 0.7 correlation to stocks. Private equity is just private stocks, subject to the same economic forces as public stocks. The same can be said for private credit versus public credit or fixed income. The oldest high-yield bond ETF has had a 0.76 correlation with stocks since inception, and dividend stocks are just a subset of stocks, again with very high correlations to stock indices. Ultimately, I see tremendous value in alternative investments, but the term alternative is a catch-all for far too many assets, many of which are not reliable diversifiers for the stocks and bonds you likely already have in your portfolio. So, if you are evaluating alternative investments beyond stocks and bonds, I find it helpful to evaluate those alternatives in the context of their correlation and expected diversification benefit, especially in economic environments where both stocks and bonds tend to struggle.